Okay, everybody, we have to do now lecture module 8. We'll call this 8A. We're going to start talking about security valuation. There's a general rule that's pretty straightforward. We've got enough tools in place, hopefully, to recognize how we're going to value securities. Or how do people place a value on something like a bond or a common stock certificate, right? It's simply the present value, right, of future cash flows. And people, right, establish such value of those future cash flows, right, discounted by, we'll say, a discount rate. We'll say appropriate to the risk of the cash flows. So the first thing we're going to deal with is bonds. It's very simple to start with bonds, and we'll move on to a little bit more complexity as we go. We're going to deal with first is a pure discount bond. All right, these are bonds that do not have interest attached to them. The way that you'll earn your interest is to buy the bond at a discount. And this will be a price below the face value. What will happen at maturity, it will pay its face value. Okay, so pure discount bonds are sometimes called zeros. Sometimes they're called bullets. Bullets, that's a term that refers to all of the return, all of the interest you get is loaded onto the final bullet, we'll call it. And what you get here is a typical real-world example, a T-bill, we'll call it. T-bills are issued by the United States Treasury. They come in 3, 6, and 12-month maturities. They're auctioned off on Mondays. Treasury establishes face value at maturity on these T-bills. They're defaulted at $10,000. So they auction off the T-bills, and the government sells. They're trying to sell enough of them to satisfy the needs of all the high bidders. Okay, so if you wanted to enter a bid, the bid that you would enter, let's say that your bid price is going to be dependent on the target interest rate you want to earn. Let's say you want to earn 5% or more interest rate. So 5% interest is, let's say, desired. Not very much, but hey, this is a default-free security. Right? You don't face any risk of default here. Okay, so you think, oh, 5% is a reasonable rate to earn. Let's say it's on a 12-month. Let's keep our math simple to begin with. And what your bid price would be on the 12-month bond is, right, the face value of 10,000 divided by 1.05 to the first power. It's raised to 1 because we're handling this as a 1-year interest earning asset. So what would you bid in this situation? Of course, you would bid no more than, right, no more than $9,523.81. Because you could take that $95.23.81, you could invest it, and if you could obtain 5% interest, in 1 year that would generate enough money so that you would have $10,000 worth of an asset, right? This is the amount you would bid in such a situation. Oh, by the way, this module is generally linked with Burke and DiMarzo, generally chapter 8 and 9 is where we're starting to pick up topics. So let's say that your bid is accepted. You pay your bid price. In 1 year, you earn $10,000. And what has happened, right, of course, is you have had a capital appreciation. So that $10,000, right, in 1 year, right, minus what you paid, $95.23.81, generated for you a capital gain, right? You have a capital gain of $475.19. That's a price appreciation. Of course, that's 5% return. So you could take the 475.19, for instance, divide by what you invested, 95.2381. Right. That's yielding for you a 5% rate of return. Suppose there's other bidders out there and they're willing to actually accept a lower level of return, below the 5%. That means they're willing to bid a higher price for their T-bills. And so your bid won't be accepted in such a case. The high bidders will take those bills. Suppose there was a bidder willing to accept a 4.5% return, right? So there's somebody who's competitive out there, and they say, hey, our desired interest rate is really 4.5%, right? So they will bid more than you. So that means a competitive bid price is standing there in the market. And now it's what? 10,000 right, divided by 1.045 raised to the first power. Well, that's 95.6938. So the U.S. government would actually prefer to sell the bill for 95.6938. Your bid price was 95.23, so you're going to lose in such a competitive bidding process. We're still inside bonds, so I'll keep this. I'll use sort of the underlines to distinguish. Suppose you're dealing with console bonds. Before we did a pure discount bond. So console bonds are different. They do not have a maturity date. So thus, the way you value them is with the perpetuity formula. See, so the present value would be, right, this value of the cash flow over R, the interest rate. In this case, the PV would be the bond price. See, so I'm just transforming the general case of measuring present value of perpetuity into the specific case. Hey, the bond price is equal to the C in the cash flow. What we'll call this is the annual interest payment that the bond offers. So some people call this a coupon, but because it's paid annually as interest, now we're calling it a console. But anyway, you have this value, C, the annual interest payment. So that's a payment, right? Divided by R, and R is the required discount rate. So R is kind of this same element here. Suppose you have a console bond and it's issued, and it let's say it pays $60 a year. So C is 60. So however long it's held by somebody, you're getting $60 a year. Let's say somebody says, hey, my required rate of return, is 8%. Right. So the present value, right, on that, this would tell us how much you're willing to really pay. Well, the price of the bond is the present value of 60 received every year at 8% interest. So that's 60 divided by 0.08, right? So that's worth $750 in present value terms. How about this next one? We'll call these level coupon bonds. So that particular species, in a sense. So this is really the most common type of bond. The level payment is called the coupon. So the coupon rate of return is based upon the face value, the maturity value of the bond. So for instance, if the bond has a coupon set at 8%, what we could do is look at the face value. Suppose the face value of the bond, and most of these typically are going to be issued at $1,000 face value, right? So now we know an 8% coupon on that face value bond of $1,000, right, generates an interest payment, right, each year. You're getting $80 per year. That will happen until the bond matures. And then at maturity, the owner gets the last interest payment and the face value of the bond. This is really most corporate bonds. And they pay interest. Usually the payment flows semi-annual. So in the above case, the $80 per year would actually be turned into $40 each of every 6 months, right? So $40 every 6 months. Now, because you're getting a semi-annual payment, you get a little bit of a technical complication with regard to this semi-annual cash flow, right? So this complicates things a tiny bit. So let's look at what happens. What happens, you have to measure the value of the bond a little bit differently. So again, it's the present value formula. Now we got to do this from time period 1 until time period, that's little t, right? Until time period t, maturity date at capital T. And this is, you got to do this with what we call a 6-month coupon payment, because the cash flow is happening, let's say at mid-year, and then it's happening at the end of year. So it's that 6-month coupon payment, okay, divided by 1 plus R. Now, R has to be, now R is always thought of in annualized terms, so what you can do is, since you're receiving a 6-month coupon payment, divide the R value by 2, right? And raise that to T, the number of payments being made, plus, of course, at the end, at the maturity moment, right, you get $1,000 back, and that has to be discounted at 1 plus R over 2, okay, raised to the capital T. So that refers to the last time period. See, so for instance, T here, what we're talking about is the number of 6-month periods until maturity. R is the annual rate. And since I'm dealing with 6-month periods, that's why we see this divisor of 2 sitting on the discount rate. Now sometimes people set T equal to the number of years. If you set T, put it this way, or T equals number of years till maturity, so now what's happening is you've got to remember that the number of years, 2T is the number of 6 months periods, and right, it's just a matter of convention, right? So you have to be sure to be careful with your conventions and stay in the same time frame. Now let's look at an example to kind of round this out. This is an example from a Wall Street Journal quote, let's say. We look inside the Wall Street Journal pages, and we see the closing info for a prior trading day. Some specific date, just think of it kind of generically, but you'll see a column for bonds. You'll have a statement regarding CUR, YLD for current yield. There'll be a volume column. There's a close, so end of day, and you'll see a net change statement. And let's see, let's pick a bond, ATT. Might be listed as 7.75/07. under the yield column 8.2. 1381, let's say, is the volume. The close is 94.50. Let's say it's up 0.25. Let's interpret. So this bond is a New York Stock Exchange bond listed by AT&T. Okay, it has a coupon rate of 7.75%. So now you know if it's a $1,000 face value bond and it pays $77.50 in interest every year. Right, that's what's going on annually. Okay, you get 2 semi-annual installments there. You're getting $38.75 every 6 months. It matures in the year 2007. Right? So we're going back in time quite a ways, right? So 07, that's just the last 2 digits of the maturity year, okay? The current yield is 8.2%. So what's going on there is you have the annual interest payment of $77.50. Call that current yield. So my interest payment is $77.50, and it's divided by its closing price. Okay, its closing price on October 25th or whatever date it was, right? It's divided by the closing price. The closing price is listed at $94.50. And it's set to the nearest tenth, right? 1,381 bonds were sold on the day, and the closing price at $94.50. What is that? That's 94.5% of the face value. So it's really $945. So 94.5% of a $1,000 face value. Kind of odd, but that's the tradition. The bonds are quoted as a percentage of their face value. And the closing price is up 25 cents on the dollar, right? Or on the, 25 cents on the dollar, it looks like, right? You have to kind of think of it by translating it into, right? See how it's 94.5%, so it's 0.25%. So New York Stock Exchange traded bonds are somewhat like stocks. They're nowadays quoted in decimals. Now let's assume the bond just paid its semi-annual coupon amount. That would be $38.75. Assume the bond is maturing at some point in 2007. We would look at the Moody's bond guide, basically. You could look this up online and find this bond. It will give you the exact coupon payment date and the maturity date. See, so if you had purchased the bond, let's say, on a particular day at its closing price of $94.50, you hold the bond to maturity, you would get a certain true rate of return. The true rate of return, this as a concept, refers to what we call the yield, right? The yield to maturity. And we're assuming that, of course, this company doesn't default on the promise to pay, right? So we can use our present value equation. And here, think through what this might look like if we were holding this to maturity. Let's say it ran like this, that it was a 10-year note, let's say. Okay, so this is running from time period 1 to 10. We're being paid $38.75 every 6 months. Divided by 1 plus r over 2. Raise that to t. You have to do that over and over and over again across the time periods, okay? And then we get $1,000 at maturity at some point in the future, right? That has to be discounted by 1 plus r over 2. And that's in the 10th time period. So 10 is the number of 6-month intervals, let's say, until maturity. So with 6-month intervals, let's say that's what's remaining in the lifespan after we purchase this. R over 2, that's the semi-annual interest rate. You have to set up the interest so that it's in the same time block as, in this case, half a year, right? 6 months. So half of an annual rate R, so it's R divided by 2. By the way, in Ross, Westerfield, Jaffe, the authors use the value, they think of the term in this way. They use a symbol Y. Our choice here will be R over 2. It's a little easier for us to understand that, oh, we're dealing with a semi-annual yield to maturity. So what's going on here is you'd have to search. You've got to search for, let's kind of highlight that, right? Make it yellow. The idea is you got to search for the value that R over 2. What is R over 2? So a little bit of searching on a spreadsheet generates 4.572% yield to maturity. Now R over 2 is a semi-annual rate. So that's because we are calculating this in the semi-annual period sort of mode, because we entered the semi-annual coupon payment. So of course you could solve for the semi-annual rate in such a situation. Now the effective annual rate is a little tricky, and that's moving us to the annual mode. So often we like to think about our interest earnings in annual terms, right? So the effective annual rate has to be, well, 1 plus R over 2 raised to the 2 because of 2 time periods passing, right? So this is 1.04572 squared. And if you subtract 1, we get ourselves back to, well, it comes to 0.09353, right? Or a semi-annual rate of 9.353%. Notice that, right? Notice if I do 2 times 0.04752, 0.04572. See how that equals 9.144. So that's called the stated annual rate. But it's a sort of faulty calculation because of the potential of accruing interest in a compounding fashion. So now we've discovered that the effective annual rate is not equal to 8.2%, which was the current yield stated on the bond. The current yield is usually not an accurate approximation for the effective rate for the bond, especially when it's maturing relatively soon, especially within 10 years. So the current yield technically is only accurate if the bond is a perpetuity. Now the current yield is easy to calculate. For a longer term bond, something like maturing beyond the 10 years, maybe a 20-year or 30-year bond, you do get a kind of a good approximation for the effective annual rate. Now we also note here the bond is yielding more than its coupon rate. The coupon rate is 7.75%. Why would that be? The reason is that the bond is selling at a discount, right? It's selling below its face value. So the owner might be holding this bond. If they hold it to maturity, they're going to get a capital gain. They're getting a $1,000 capital gain. A net of $1,000 minus $945. Because that's how much it's selling for if you buy it right now. You get a $55 capital gain. That enhances the 7.75% coupon payment, right? So the net result is a return above the coupon rate. What's your return relative to the coupon rate if the bond is selling at a premium, right? Suppose this bond is selling for more than its face value. So now your effective annual rate would be less than the coupon rate. You could prove a statement like this to yourself. Suppose that you have a quoted bond selling for 103. That is to say 103% of face value. That's equal to, of course, a price that you would pay of $1,030. You could, so that's the face value times the 1.03, right? And now R over 2, you could do a little searching again by going back into the previous present value equation and adjusting. And now you're getting an R over 2 equal to 0.03514. Now 2 times that is 7.028%. Multiply by 2 times, I have 7.028%. So there's my stated annual return. Now, of course, you see that's less than the coupon rate of 7.75%. So you have, of course, there's a capital loss of $30, right? It's reducing or creating an offset to your 7.75%. So what I'm going to do is I'm going to hold there. We're going to put this one up. It's long enough as it is. And what we'll do is switch to a continued example, or 2, we'll call it, which gives us a little bit of extra information about, say, we're going to, next up, a goal is to understand how we get exposed to reinvestment risk. Try to understand what that is. And we'll also talk about price risk a little bit to kind of complete our analysis of a bond. And then we'll switch to valuing, right, common stock. Try to understand the theory of common stock valuation. Okay, so for now what we'll do is save this, put it up on Blackboard for you all.